Hey everyone, welcome back to another video. Today I'm going to be talking about PyAlgoTrade. It's a Python algorithmic trading library with an emphasis on backtesting. Now in this channel, I've already covered Backtrader, so I've released a few tutorials on Backtrader, but not everyone likes Backtrader. Some people find it confusing, so I thought I'd explore a few alternatives and show you how they work in case you like one of these alternatives better. So the first one I'm going to start off with is PyAlgoTrade, and I have the open source project pulled up here, and you see it has a focus on backtesting, and just like any other backtesting library, let's say you have some strategy, some idea, some hypothesis on how you want to trade the market, and you want to see how well that strategy would have performed on historical data. Or let's say you got some idea from some other guru or someone that said you can do this thing to make lots of money in the stock market, and you want to verify whether what they're saying has any validity to it. You should be able to do this using a library like Backtrader or PyAlgoTrade. So if you go on YouTube, you're watching this channel on YouTube, you'll find all these people saying, oh, you can make $200 a day or $200 in 15 minutes, and you can scale this up and type whatever you want here. So if I typed $1,000 a day, you'll get this guy. If you type $2,000 a day, however much money you want to make in a day, there's going to be someone that claims you can follow this simple strategy to make $2,000. So this guy's really popular. He says, make $2,000 a day trading 1 minute, 3-bar play. And if you look on his Instagram page, it has like Lamborghinis and things like that. Or, you'll see this guy with this Lambo right there and all that kind of stuff and posing with a house. Usually I'm very skeptical of, you should probably be skeptical of anyone that posts pictures with their car and stuff, because most of the people I know with a lot of money, they don't make a big deal about it, or they drive like a Buick or a Prius or something right here in Silicon Valley, maybe a Tesla, but those aren't even that expensive anymore. So anyway, so if someone makes a claim like this, that you can just look at that 3-bar play strategy right there and make $2,000 a day day trading, then that should be easily testable, right? We have all the price data from the past, and we should be able to feed it into a backtesting library and see whether that's true or not, right? We don't need to take someone's word for it. We don't need anyone to sell us on it. We should be able to just run the numbers. And you'll see how I did that in the past. If you watch my video on opening range breakout, it had like a 15-minute strategy, and I actually backtested it for all 500 stocks, I believe, in the S&P 500, maybe all QQQ. So I did every single stock, and it turned out that AMD was the one that performed the best with the opening range breakout strategy, but it turned out just buying and holding AMD stock would have done better during that time period. So it actually didn't end up being that great. So so let's talk about a strategy. What strategy? I tried to think of a strategy that we could backtest that's not too complicated. That way I can show you a short tutorial on it and learn the library easily. But I also didn't want to show a strategy that underperformed just buying and holding, so I thought I'd show a simple strategy that outperformed buying and holding the S&P 500. And that might not be that exciting to anyone. It doesn't say make $2,000 in 15 minutes or anything like that. But if you've ever traded for a very long period of time and tried to outperform the S&P 500, it's actually not that easy, especially when you take into account dividends, all the taxes you pay for very short-term trading. There's a lot of factors at play. There's a lot of emotions involved. So it's actually very good to outperform the S&P 500 or the QQQ, for instance. So the simplest strategy that is documented that I found was this one by Steve Burns. He writes a lot of books on trading, and he has this article here. This is from October of 2019, moving average strategy that crushes buy and hold. And this strategy is actually super simple. All he did is over the past 20 years, so from the dot-com crash until the present day, or until when this article was written, he just had an end-of-the-month strategy. So at the end of every month, if the price was below the 200-day moving average for SPY, the S&P 500, then you would sell. And if it closed above the 200-day moving average, then you could buy and enter the position and hold it until it closed below the 200-day moving average. And note the only actions are taken at the end of the month. So the last trading day of the month is when we determine whether to take a trade. So if you scroll down to the bottom of the page, he didn't just say that it outperformed. He actually showed us the data on what trades were actually taken, which, you got to respect that. And you look at it, you can see the chart here of the SPY, and you can also see this equity curve here to see the starting balance and how this portfolio would have finished by using this strategy. And then he also shows the data on the number of winning trades and the number of losing trades. And you can see with this strategy, he got a 370% return, which is great. Most people would be very happy with that. And the S&P 500 buy and hold only returned 210%, which is pretty good too. Yeah, but you didn't have to sit in front of your computer every day, day trading all day. You got your 370% and you only made 11 trades over the course of 20 years. So you saved a lot of time that you could have allocated to other things. So in addition to outperforming the S&P 500, another great thing about this strategy is that you didn't have to have a huge drawdown. So a lot of people will say you should just buy and hold the S&P 500 and hold it for 20 years and you'll do great. And it turns out that is true. However, have you actually ever held the S&P 500 for 20 years straight? Some people can do it. I personally have not been able to do it. So I've been trading for over a decade now, and I did have a portfolio before the financial crisis. And if you held all the way through this thing and just kept going without panicking at all, congratulations. I personally had trouble holding and taking a 55% drawdown. And while early in your career, like a lot of people, they started trading in the past year. So they've withstood a 10% dip or a little growth stock dip, but they haven't really experienced a 55% drawdown like that, right? Or maybe they have, but their portfolio is only $10,000 or something like that. So I've been able to withstand, on a 5-figure account, I can withstand a pretty good drawdown, maybe 30%, 20%, I don't know. You need to determine your risk threshold. But let's pretend you've been working since then and you've grown your account from 5 figures to 7 figures in the present day, right? And can you imagine, you've saved up $2 million, you've worked for 20 years, and seeing that $2 million account have a 55% drawdown, so you have a drawdown of over $1 million. Can you really stomach that? Or do you need some rules upon which you might exit? And so the nice thing about this strategy is instead of enduring a full 55% drawdown and just holding over the course of this strategy, a 20% drawdown is the biggest drawdown you had to withstand. So if you have $1 million and you watch it go down to 800K, you can probably deal with that. I feel like I could deal with that. But watching $1 million go to $450,000, you're like, And once you get really late in your career and you've been working a long time, there's a point in which you might not be able to make all that money back. Maybe you had some luck that let you get there. And so it's nice to use a long-term strategy like this, and following the trend here of the simple 200-day moving average might be something that helps you stay in it for the long haul. And another beauty of this strategy is look how few trades you had to make, right? There was only 11 trades executed, right? And you didn't have a big drawdown. And what's nice about having fewer trades, I personally love not taking many trades. I know everyone on this channel wants me to do a minute by minute or tick by tick day trading bot, which is cool. It's cool to see happen. But also, I live in California. Short-term capital gains taxes are a lot. If you pay 30 or 40% taxes when you start getting bigger and bigger gains, you really notice that. It's very, very noticeable when you have a huge taxable gain at the end of the year. And what's cool about this is it is able to ride some very long-term trends. And so if you look, there was a trade here from April of 2003, pretty much the bottom of the dot-com crash, and all the way to until December 31st, 2007. So you got this 70% return here. You were in the trade over 1,100 days. So you paid long-term capital gains tax, you got dividends over the course of several years, and you rode this entire trend here, and you got out whenever the S&P 500 closed below the 200-day moving average. This entire 2008 financial crisis happened, and you were just out of the market, right? And you didn't get back in until May of 2009. So you didn't get this very bottom here, but you got back in right here when this trend changed and it went above the 200-day moving average, and you were back in. So you dodged this. So you navigated the financial crisis, you navigated the dot-com crash where the NASDAQ fell by nearly 80%. So to put that in perspective now, picture the S&P 500 falling from 4,200 to like 900. You know, that'd be crazy. So I personally think this is a great way to start our discussion of PyAlgoTrade. Number one, because the strategy is pretty easy to backtest. It's pretty easy to code and follow, so it makes a good learning example. Number two, it actually outperformed the S&P 500, which is great. You know, Buffett bet people $1 million they couldn't outperform it, and he won the bet. And number three, this was tested over the course of 20 years. When you look at these, people are just cherry picking simple examples of a trade that already happened, like yesterday, you know, one day or one very specific chart for a very short-term period, whereas this strategy navigated a 20-year period with a whole variety of market conditions. Not only did it navigate the dot-com crash, which wiped a lot of people out, it navigated the financial crisis of 2008, which destroyed a lot of people, and if you fast forward till last year, this article was written before then, it actually helped you navigate the COVID crash, maybe by luck, I don't know, but actually this helped dodge the majority of the drawdown that you would have gotten from the COVID crash that happened in March of 2020. So what I've done is written this strategy using PyAlgoTrade in Python code, and you see on the right here, I've run the script and it showed me the dates that this strategy would have executed and why, and I can see the different dates. I can see where I'm buying and selling, where the 200-day moving average is, and I see all these dates. I can see my final portfolio value, and I'm also using a feature called analyzers, which analyzes this strategy. So I can see the number of trades taken, the average profit, max profit, average return. You can see our largest drawdown, all these different stats about the strategy. And also it produces a chart of the buy and sell points. And so you see on here all these green arrows. So this green arrow right here in 2003 is where you enter the trade, and the red arrow is where you exit the trade. I also have the 200-day moving average plotted here, and you also see the growth of the portfolio over time over the course of this 20-year period, and you see it closely matches what is shown in Steve Burns' article. So a quick roadmap of what we're about to do. I'm going to backtest just buying and holding the S&P 500, which is a good way to just show you the basic structure of PyAlgoTrade. Then second, we're going to implement this 200-day moving average strategy. And then number three, I'm going to show you how to use these analyzers and plotting and maybe the optimizers as well. That way we could even optimize the strategy if we would like. So in the next video, I'm going to jump right into coding these strategies using Python and PyAlgoTrade. So thanks a lot for watching, and see you in the next video.